Today we'll continue our discussion of beta. I want to give you just mathematically what beta looks like with some stocks so you can see the diversification benefit of unsystematic risk against several stocks. I want to show you how to calculate rolling beta, although there are several videos out there showing you how to do that, and contrast it to regression beta. And then we'll talk about how do you actually come up with the beta. How do you forecast the beta? Once we have beta, we can then get our discount rate to value securities, especially stocks. So then we'll hopefully get started here pretty soon, either this class or the next one on security valuation. We'll start with bonds, but just the concept of security valuation. So this is a spreadsheet, real simple spreadsheet. I brought in the prices for Apple, Ford, Bank of America, 3M, General Dynamics, AT&T, CVS, the pharmacy, Wal-Mart, and Exxon. I then calculated the returns. These are the holding period returns, just like we calculated before. And you can see we went back to 1986 on a weekly basis. These are weekly. So here's the annualized returns. Remember, if it's weekly, we take the average and multiply by 52. So this is an arithmetic average return. You can see Apple has by far the highest return, but the other stocks are all double-digit returns. And then the risk is just the standard deviation. I annualize that. The annualized standard deviation, you don't multiply by 52, you multiply by the square root of 52. Because standard deviation is not annual, you don't annualize that, you annualize volatility. So essentially we take volatility, multiply it by 52, and then take the square root, or we take standard deviation times the square root of 52. So here's Apple, Ford's. On the lowest returning one is AT&T. Second highest is the Bank of America, interestingly, and then by far Apple. Apple has almost twice the return of anybody else. But the question is, what happens to our portfolio if we start adding other stocks? If we only have Apple in our portfolio, our return has been 28 and our risk has been 42. As you can see, as we go down, the risk generally are declining, not every single time, but generally declining. So what I do over here on the right is I say, what will our portfolio look like if we have 100% in Apple? So there's our return, our risk. Our return, again, we can do the same return, take the average times 52, just like we had before, 28.59. Then what I did is, if you look on here, I've got columns B and C. Columns B and C, 50% in each, that's Apple and Ford. So the second column is, what would our portfolio look like if we had only two stocks in it? So our return's going to fall. Our return's just going to be the average of Apple and Ford. So it's going to be, the average is 21.5, so 21.5%. Our return's going to drop, obviously, because Ford has a lower return than Apple. But what happens to the risk? Well, the risk drops to 32%. So you have to say, well, maybe that's because Ford's less risky, and Ford is lower standard deviation. But if you took Apple and Ford's standard deviation, took the average of that, that would have been 41.2%. And yet the standard deviation in this portfolio is only 32. I mean, just think about that. The average of Apple and Ford is 41.2. Let me lock that in. But the actual standard deviation of portfolio is 32. What's the difference? It's that unsystematic risk. About a fourth of the risk disappears just by having these two stocks in your portfolio. Now we go to the next one. Our return is now 19. It's fallen again, and our risk has fallen down to 30%. But the average standard deviation of those three stocks is 41. So again, we've seen an over 25% reduction in our risk. And how to reduce our risk 25%? By doing nothing more than allocating to three stocks, by pure diversification. And if you look at it, you have Ford and Bank of America have a slightly lower risk than Apple, but they're all about the same. and yet the risk is dropping dramatically. You would think the risk would have stayed about 40%, but because of diversification, because unsystematic risk is disappearing, it's coming now. Now with 3M's risk is much lower, so the average risk when you throw 3M definitely comes down, but the risk of the 4 stocks is still, look, much lower. How much have you reduced your risk? By almost 30%. And your return is coming down too. Our return keeps falling and falling. Now we do a 5th stock. The 5th stock is General Dynamics. Its risk is actually higher than 3M's, and yet the risk is still falling. And our return now is stabilizing around 17%. Our average risk of all these stocks is 34%, and yet the actual risk is 23%. Then we add a 6th stock. So we add AT&T. AT&T has a bad return, so our return will come down, but the risk is about the same as the previous 3. So yeah, our return keeps dropping, but our risk keeps dropping dramatically, the actual risk. And now here we look at it, our risk is actually down more than 34%. From the average of the 6 stocks, our risk is dropped. So as we keep adding stocks, we keep getting more advantage of risk. And here on the return versus the risk, here you can see the risk hardly drops at all, but here it dropped pretty dramatically. So now our risk is down. Well, that time it kind of went sideways. We add another stock here. Our return did not change much at all, but our risk still came down. Our risk has been dropped about 38%. At the very end of it all, our return is 15.29%. Our risk is 18.67. Our risk has been reduced almost 40% by doing nothing else. So remember, this 30%, this is simply the average of all these standard deviations, 30.2%. And yet when we have all these stocks together, our risk is not 30.24, it's 18.67. It's almost 40% lower. At some point, we're going to get to the point where your risk just doesn't drop very much anymore. It drops about the same rate as the average of the risk. And why? Well, because you become well diversified. Usually when you get to about 15 to 20 to 25 stocks, 100% of your unsystematic risk will disappear, and the only risk you have left is the systematic risk. Now, we haven't gotten to that point because I only have 9 stocks, but we've reduced our risk 38% by doing nothing. This is risk reduction due entirely to diversification. Nothing else. Risk reduction entirely due to diversification. We reduce our risk almost 40% by doing nothing more than diversifying. Now, our return did come down too, and that's part of how I put the order of these stocks. If we hadn't had Apple in here, if we'd only had these other stocks, you can see our return would have actually kind of bumped up and down. We had, Wal-Mart's higher than everybody but Bank of America, but as we had added, our return kind of would have fluctuated up and down. Because I started with Apple, my returns has to come down because Apple had by far the highest return. So I should probably find another stock besides Apple just to show you that return is not as impacted as much. But you notice as we add more stocks, the impact on return is much smaller than the impact on anything else. But that's what we mean by unsystematic risk. Being able to eliminate it costly. It doesn't impact the return on the portfolio. Is just the average expected return of all the stocks. You just average them. But the risk of the portfolio is not the average risk of all the stocks because of this. Because correlation is not 1.0. Correlation were 1.0. If all these stocks were perfectly correlated to each other, then a risk would just be the weighted average risk of all the individual stocks. But because these stocks are not perfectly correlated, the risk drops pretty dramatically. which means a lot of the risk of Apple and Ford is disappearing. What risk is disappearing? That's 70 to 80%. That is nothing more than unsystematic risk. And so we want to use beta. Beta is going to tell us how much of the risk of these stocks is related to the overall stock market. That's what you should be compensated for. Alright, so we talked the last class, we finished up with this unsystematic risk. There can be anywhere, well, it depends on the market, but generally 70-80% of the risk of an individual stock is unsystematic risk that disappears when you combine the stock with other stocks through simple diversification, just adding more stocks to your portfolio. And we talked about why HEB or Facebook or these firms go public. To me, HEB is going to be under a lot of pressure to go public because the value of HEB will go up several times. Not 5 or 10%, but 300, 400%, because the discount rate for HEB will drop dramatically once they become a public company that can be diversified into another portfolio. We just saw the Excel spreadsheet that shows that benefit to risk just by being part of a diversified portfolio. Now, these are some statements I've heard historically that show a lack of understanding of what beta means. So you might hear someone say, stock betas rose in 2008 due to the financial crisis. Well, that doesn't make sense. Why? Because the beta of the stock portfolio, of the stock market, must be 1 by definition. And if the beta of the stock market is 1, that means the average beta of all the stocks in the market must be 1. Remember, the beta of a portfolio is just the weighted average betas of the individual stocks. So if the stock market's beta is 1, then the average stock beta is 1. So stock betas did not rise in 2008 because for every stock beta that rose, you had to have another one that fell. So Exxon's beta might have risen. Bank of America beta may have risen in 2008. It was a financial crisis. Energy prices were a big part of that crisis. So energy companies, they became more sensitive to the economy. Bank stocks obviously are in the middle of a financial crisis and a banking crisis with the subprime crisis. So bank stock betas jumped from like 1.5 to 2.9, but Walmart's beta dropped to below 0. It actually became negative during that time. So it does not make sense to say, wow, stock betas must be up, look at this crisis, because on average they have to be 1. I've actually seen this next one on an exam. If you see this question on an exam, you need to challenge the professor. But people say you have a stock with a beta of 1.1 and the S&P rises 10%. What would you expect this stock to do? And the answer they might be looking for is 11%. If your beta is 1.1 and the S&P is up 10%, and you take 10% times 1.1, you get 11%. But that's not true. Remember, beta only captures 20% of the risk of a stock. So the other 80% of the stock's risk could go all over the place. It's possible your beta is 1.1 and the market's up 10% and your stock could be down 30% because some product didn't get approved or some competitor did something. So the answer to that question is you have no idea. There may be a slight tendency that if the stock market's up 10% for this stock to be up a little more than 10%. If it's got a 1.1 beta, but there's so much noise. 80% of the volatility going in this stock is not being captured by betas, so it could be almost anything. Alright, let's talk about rolling beta. I do have videos out there that show you how to do that. So be careful. Some of my videos go back, use 3 years of data. Some use 5 years. I use 5 years now, and I'll show you why when we do this. When we look at Yahoo Finance, why I've switched to 5 years. So be careful if you look at my videos. If it's using 3 years and weekly data, just know I've switched to 5 years and monthly data. Alright, so I'm going to actually do Walmart as my example. So I'm going to go into Yahoo Finance and type Walmart. I'm going to go to historical data. So we're going to get Walmart data. We'll go back as far in history as we can. We'll do monthly and apply. And I'll download that. So we have good Walmart data here. So we go back to January 1985. I'm going to erase everything but the adjusted close. So January 1985, I would get the S&P 500 from the same database. However, for some reason, Yahoo Finance does not give me S&P 500, so we'll have to figure out how to handle that. Robert Schiller's data might work if you just type in Robert Schiller online data and click on this button. He will give you this data. So this is the S&P back to 1870 something. So if we're going to do the we're going to do Wal-Mart back to 1985. So January 1985, I'm going to use the Robert Schiller data and go back to January 1985. There it is right there. And he goes through, we'll go through to February 2021. And so there we got our data. So I brought in Wal-Mart, bought in the S&P 500, and we don't have, I did this during the month of March, so when you do this, if you're in the month of March, delete this. If you're in the month of February, delete that data, because we need a full month worth of data. Alright, so there's Wal-Mart, there's the S&P, so now we'll do the holding period return for Wal-Mart, the holding period return for S&P 500. We can't do January because my first data. Remember, the holding period return is ending market value minus beginning market value divided by beginning market value. And I don't know why it's giving me zeros. That's strange, but anyway, it looks like it just thinks it's the same. I'll copy that over for the S&P 500. We'll make these percents. So there you see the numbers. You can see Wal-Mart has had a tough time of it the last few months. So there's the numbers. So let's look at the beta for the entire period. Remember, here we use slope, and you do the stock first, and then you do the market second. So there's the beta, 0.48. So what I want to use is a rolling beta. So by rolling beta, we're going to do 5 years with monthly data. And somehow I may just have to create a spreadsheet for you that has the S&P 500 and just make that available, and you'll just type it in next to your company so that you can have it, because it looks like Yahoo Finance no longer does that for us. I could use the SPY, the ETF, the Exchange Traded Fund, for the S&P 500, but it doesn't go back far enough in history, and I want to go back as far as we can. So rolling beta. So let's think about that. We want to do 5 years with monthly data. So let me count. So I'm going to put 1 in the first one, and I'm going to do plus that plus 1, just so I can count down and go down about 60 rows, because 5 years times 12 months is 60 months. So we can go find 60 months. There's month number 60. So I'm going to get rid of everything but that month 60. We're going to start right there. So I want to do equal slope, and I want to do everything for those last 5 years. And there's my beginning beta right there. And I can copy that down. So here's the beta for the 5 years ending January 1990. Here's the beta. Look how quickly it starts dropping. Here's the beta for the 5 years ending January 1993. So this is the rolling beta. Let's do the median, the 0.9%, and the 0.1% and the 0.9%. So here's our percentiles. So we'll just do equal percentile. We'll just do the entire period. Let's lock that in, hit your F4, lock that in, comma, and your 0.5, lock that in. But here only lock in the well, lock in the line number 61, hit enter, and we'll copy that across. So let's look at what these numbers are telling us. I'll put the formulas up above so you can see them, the very first formula on each one. So when you do this for paper 3, you'll do something very similar to this. And now we can just copy this down. These numbers shouldn't change. You know you got a problem if these numbers are changing, because if you lock them in with the dollar signs like this, you don't want to lock in the G, because you can copy it over and make it GHI on the 0.5, the 0.1, and 0.9. The 0.5 is the median. The 0.1 is the 10th percentile, and the 0.9 is the 90th percentile. So what that means is 50% of the time Wal-Mart's beta has been above 0.38, 50% of the time it's been below 0.38. 10% of the time their beta has actually been below 5%, 0.05, and 90% of the time their beta has been below 107. And now we're just going to graph this whole thing. Now look at the very last one, 0.14. And if we look at this and we go into Yahoo Finance and look at the summary for Wal-Mart, you'll see their beta is reported at 0.47. We're getting 0.14, but this beta is coming using a couple more data points because they went into March, and you know in March they were down quite a bit. So usually you can use that very last point as somewhat of a check to make sure what you have is correct. I'm also concerned about using the sealer data, because I think the sealer data, I think we got a little bit of noise here. And so that's why I've got to find the S&P back historically, because I think the sealer data, this is not the S&P 500 at the end of February. This is Walmart stock price at the end of February, but I think the way sealer does it, this is the average S&P for the month of February. I know this says 2/1, but it's actually 2 February 2021. So if you use the Walmart data like this, if it says 2/1, 2/1, 2/1, that's really not true. So I can change the format of this and just change it so it's just month and year, so we don't have that problem. So I'm going to do date, and then I'm going to do month and year. Let's just do it like that. Alright, so February 21. Alright, so what we want to do is to graph all of this. So I'm going to highlight this whole thing and insert. I'm just going to do a regular line graph. And I'll move this to another sheet. Well, before we do that, let's put the dates in there. So I'll right click and select the data. And then over on the date side, I'll go in and highlight the dates. So I have some good dates in there. And then let's move all this to another chart, to another page. And this is what you'll put into your paper 3. So this is Walmart rolling beta five years using monthly data. I'm going to move my axis on labels. I'm going to say I want it low. And I'm going to fold that and just expand it a little bit. And then I'm going to go in and name things. So the very first one is Walmart rolling beta. The second one is the median. The next one is the 10th percentile. the last one is the 90th percentile. Say OK. So if you look at this, you notice Walmart, when it first started out, had a very high beta, well above 1. We know they're a discount store. We know they do a lot of groceries, so you expect their beta to be well below 1. But it tracked around 1 for quite a while. And then coming into the 90s and 2000, the beta really dropped. It even dropped to negative. It was as low as negative 0.14, but it has since then ranged in the kind of 0 to 0.4 range. The last one was 0.14. Yahoo Finance will report, you can see it's coming up. So Yahoo Finance is probably, it's reporting using data through March, so it has a little bit more data. And that's probably why it's jumped up back up to 0.4. But that's the data for the entire period. The median is 0.4. The max, the 90% is above 1. I would never use a beta above 1 for Walmart. 0.4 seems way too low to me as well. I generally think of Walmart as being a 0.7 beta company, but you can see, looking at their history, boy, they hardly, in the last several years, they've spent no time above 0.6. So, really, this century, they have consistently been below 0.6. Part of that is they did extremely well in 2008. They did extremely well in 2020, those 2 years when the markets really moved. You can see how their beta really dropped after the 2020 COVID time. So I guess they've proven themselves to be a good diversifier. They really have done well in 2 very serious markets of 2008 and 2020, where they did well. It wasn't just that they didn't lose as much as other stocks. They were actually up dramatically. All right, so we can always clean this up some, put some bolding in there, just make it a little easier to read. But this is the chart you want to get into your paper. Now, if you took another finance class, not from me, but from somebody else, you might have done this, where you highlighted the returns of your company. So here's the returns of Walmart, returns of S&P 500, and you inserted an XY graph. And then you added the trend line. So you may have done that, and the slope of this trend line is the beta. That's what we call a regression beta, but for the entire period of time. And so I've seen a lot of these, so you can see that's a really flat slope. 0.14 or whatever it was, I guess 0.38 or 0.4 for the entire time. Really, very low slope. If it was 1, if the slope were 1, you would expect it would just be a diagonal line right through the middle. So this is a low beta stock. I prefer this, and one reason I prefer this, if you do regression for the entire time, it's going to be so much skewed by this period over here. We can definitely see this Walmart makes no sense at all. So if we did our beta starting here, like in this century, the 21st century, we would have had a much lower beta. The median probably would have been 0.2. So, why is their beta so high back here? And that's just the norm for small companies starting out. They tend to have high betas. In fact, over time, you expect betas they get closer to 1. That's the theory. Walmart's not getting closer to 1. It seems like it's actually getting further away from 1. But at the beginning of its history, it definitely started getting closer to 1 pretty quickly. It is a discount store. You would expect it to be less than 1. All right, so I found the S&P data back to 1985, and when I did that with the actual data, I get a different looking chart. So I actually got it fixed, and here, when I did that, I found the actual data. So what I was getting when I used the Robert Shiller data, I wasn't getting the actual S&P, I was getting the average S&P for the month. So here I found the actual data. I'll somehow get this to you so you can use the data, the correct data, since unless Yahoo Finance fixes their website. So using that, The very last beta for the 5 years is 0.48. When you go back and look at Wal-Mart on Yahoo Finance, what you discover is that the beta reported for Wal-Mart is much closer to that very, very last number. But look at the summary for Wal-Mart. You can see that their beta is reported at 0.47. And when I use the correct data for the S&P 500, I get 0.48 at the end. So that makes me feel much better. So I got the right data, and I'll work. If we can't get this from S&P, I'll work. Maybe I'll get it out of the Bloomberg machine or somewhere, so that you will have the data you need for paper 3 if Yahoo Finance is not giving that to us. So this gives us a better number. The beta for the entire period was 0.74. That to me makes a lot more sense. We look at the chart, it's still pretty low. The median's 0.6. That makes more sense than what we had before at around 0.4. So with good data, I got a much better rolling beta. And while the current beta is pretty low at 0.48, it makes more sense to me than what we got with the previous chart. So I usually, for a firm like a Wal-Mart, I'll usually use a 0.7 for their beta. Do I need to come down to 0.6 or 0.5? We'll have to figure that out. We'll have to talk about it. But at least we have much better data here. So it makes a difference, right? We want to use the actual S&P 500, so we don't have the last day of the month compared to the average for the month. We want the last day of the month compared to the last day of the month, so we're really comparing apples and apples throughout. And so that did make quite a bit of difference to my data. So let's try this again with another stock just to see. Let's try Tesla. So you put the stock in there, and then you get the historical data. You go back as far as you can. This won't go back as far because Tesla doesn't have much history as Walmart. It goes back to 2010. Do monthly, apply. Then we'll download that, so we'll get Tesla's data. Once you get Tesla's data, you then get rid of everything but the adjusted close. If you want to change it to dollars and cents, so here is TSLA. We went back to July 2010. So if I go over to my S&P 500 data, alright, so I'm going to bring in the S&P 500. There's a date problem with the S&P 500 data that's a little bit concerning. So we're coming from July 2010, but for some reason July 2010 is actually June 2010 here. So I'm going to copy over to Tesla just to make sure it lines up at the end. You can see it lines up at the end. So I'm going to stick with it. There's some date issue going on here. It's just off. It looks like it's off a month, but it's really not off a month. It may be the way I copied it in. So we're going to have some S&P 500 issues here, but this is correct, and we'll actually see that it's correct when we do this. So there's the S&P 500, and so we'll do the holding period return for Tesla, the holding period return for the S&P 500. So to do that, so you bring in the data. I'll make sure you have good S&P 500 data somehow so that it's all lined up. But the Tesla's return, you take the ending market value minus beginning market value, divide it by the beginning market value. That gives you the return for Tesla that first month. You can copy that over for the market. Copy that down. We got returns all the way down. We know Tesla just absolutely soared for 3 months there, up almost over 80%, but then has dropped off since then. Let's get the beta for the whole period. What would you think? This is Tesla's, so you would expect a very high beta here. But let's try it. They give us. This is when we'll figure out if we got good or bad data. So we must have good data to get a beta of 1.51, so that makes sense. So let's try the rolling beta. So we'll go down. Remember, you just find 60 months. to get you your 5 years. And we'll do equal slope, and we'll do Tesla back to 5 years, S&P 500 back 5 years. You can see their initial beta was low, but then we'll do the 0.5, the 0.1, the 0.9. So here's the percentile. So we can copy this rolling beta down. You might do something real quick here. When you copy the beta down, look at that very last one, 2.06, and you might go back to Tesla, back to the summary on Tesla, and just see what they're reporting as a beta. And they're reporting 206. So you can see how that gives me confidence. The fact that we have some data issues, we cannot get the S&P 500 into our Excel easily the way we were in the past. Make sure you double check this. I have students who have obvious data issues. They get a beta of 0 on a stock like Tesla, and they turn that in their paper. You should know, there comes a point where you should just know the number's not right. That's when I know we've got a problem. When a student calculates a number and the result they give is obviously wrong, and yet they still go with it. There's something wrong with just the comprehension. We've done a bad job in teaching that. So here you have a way to test it. Your very last number should be really close. That's how I knew I had somewhat of a problem with Wal-Mart. My last number was 0.14, and yet Yahoo Finance showed it as 0.48, 0.47. So I knew I had a little bit of a data issue here, but this Tesla looks like the data is exactly right. So even though it looks like my dates were off, they're actually correct. But we'll get that, we'll get it to work. So there's my rolling beta. And then I'm going to do equal percentile. And I'm going to highlight this whole area, hit my F4 to lock it in, comma, my percentile, and I'll lock that in by locking in the row. So the median is only 1.02. They've been as low as 0.53. 90% of the time they've been below 1.43. So right now at above 2, they're in a very, very high period. So we'll graph all of that. So here we have Tesla rolling beta, 5 years using monthly data. We can put some years in there. Let's select the data and let's edit this and go over. Put that in there. Put the dates in there. So there's our rolling beta. Now what do you notice? Now this is real key. That's why I like this rolling beta. If we were to do the typical that they do in the other classes, and we just highlighted these two and we insert, this is what you probably did in your other class, and then you put the trend line in there, you've got a fairly steep trend line because it's got a beta of 2. You can see it's the rise is much faster than the run. So you're definitely seeing a very different number when you do it over the long term. It's not 2 though. The beta over the entire period of time was 1.51, so it's not quite the 2, but you use 1.51. But when you look at this, and let's move it to a chart so we can actually see it a little bit better. So if you look at this, most of the time it's actually spent quite a bit of time just around 1. So you can see 1 is the median. But if you use Yahoo Finance is showing it as 2. If you use the long term, you got 1.5 if you use for the entire period of time. But if you use the rolling, you get a much, much different answer. So you can see, and we could use weekly data. We could use daily data. And if we use weekly or daily data, we'll get another set of answers. And so why do I use 5-year rolling monthly data? Look at what it says in Yahoo Finance. It's beta 5-year monthly. That's what they're using. This used to be 3-year weekly, and that's the reason I switched from doing a 3-year rolling beta to doing a 5-year rolling beta, and why I switched from weekly to monthly. That way, that very last number, you can tie it back to what's in your, or at least be close. It should be pretty close. It's possible they have some March data in there, because we're stopping at February, and it's possible they went into March, so you could be off slightly, but it shouldn't be radical, because you're only adding 1 month to the end. So that's what they use, but if you look at the historical beta, you look real quickly and you say, well, the median's been 1, but the most recent one is 2, the whole period is 1.5. You've got 3 very different numbers, and if you value Tesla with a 1 beta, a 1.5 beta, and a 2.1 beta, you will get very radically different valuations for Tesla. And that's part of the problem with beta, is that it's so unstable. So what can we do with this information that beta is so unstable? So there's a video you can watch that does the 3-year, but now you have this video, so I would just stick with this video. I've given you 2 examples. So how do you forecast? What are you going to do in paper 3? What are you going to do on this exam 2? You have a 4-step process. Step 1 is revenue sensitivity. Step 2 is operating leverage. Step 3 is financial leverage. And step 4 is history, what we just did on the history. So let's go back and look at each one of these steps. Step 1 is what I call revenue sensitivity, or just defining your firm. Is your firm a defensive company, or is it a cyclical company? If the economy goes in recession, does your firm revenue fall less or more? And here I'm focused on revenues. Does your firm's revenues fall more or less than the average firm? If they sell a discretionary product, or do they sell a staple? So I'll say forward here, obviously with Tesla, Tesla should be greater than 1 because it sells a discretionary product. Kroger's, I was using Wal-Mart in mine. Kroger's or Wal-Mart should be less than 1 because they're defensive companies. So start with that. That's the first thing. Define your company. Is it defensive? Is it cyclical? Or is it somewhere in between? So Walmart would be defensive, well below 1. Tesla would be cyclical, definitely above 1. And so here's the industries. We saw this earlier in the class, just typical industries and what betas you would expect. So consumer discretionary, that's where Tesla would be, anywhere from 1.2 to 2.5. Consumer staples, that's where Walmart is, 0.4 to 0.8. I might use a 0.6 or 0.7 for Walmart. I might use a 1.5 or so for Tesla. Step 2 is operating leverage. Operating leverage is the degree that they have fixed costs in their cost structure. So do they have a salary workforce? Do they have a unionized workforce? Or do they mainly have an hourly workforce? So Walmart, they mainly have an hourly workforce. Their cost of goods sold and their margins are very stable. So when their cost of goods sold go up, their revenue will go up. If banana prices go up, they're going to charge more for banana. So if their input prices go up, they charge more. So Walmart has a very stable gross margin and actually fairly stable net margins. So it implies Walmart does not have really high fixed costs. Probably their biggest fixed cost is depreciation because of depreciating all the buildings, but it probably tends to be a low operating leverage business. I'm going to give you a way to actually calculate this here, probably next class, or maybe when we do paper 3 in detail. I'll show you a way to do that. What about Tesla? Tesla is probably unionized workforce, although I'm not 100% sure on that, but I would assume you think auto manufacturing, that'd be unionized. So that's the salary workforce. They may have some paid based on hour, but probably most of it is unionized contract with a lot of healthcare and pension and a lot of fixed costs that are just going to be costs you're going to incur no matter what the economy is doing. If the economy weakens, obviously they're going to lay people off, but Tesla is very unusual versus the other auto manufacturing. Obviously, they've been somewhat immune to the economies just because they've been a small company growing fast, and that probably is why their beta looks lower than the industry. But going forward, you would think they would have the revenue sensitivity and the fixed costs similar to Ford and GM that are much higher, 1.5 to 2 beta types of companies. Maybe they have some ongoing marketing campaigns. How elastic is the demand for their product? So if they raise the price of their product, do their volumes drop dramatically? That would be elastic. So they raise their prices 7%, but their volumes fall 10%. So your cost of goods sold go up 7%. You try to raise your prices 7%, but if you do, you're going to lose 10, 20% of your volumes. You lose money, so you can't raise your prices. So you just have to eat that, and that's going to make your net income much more volatile. If you're a cigarette company and there's a new tax on cigarettes, so your cost of goods sold goes up, or the price, the taxes go up, and you raise your prices, and people keep buying your product because it's an inelastic demand. So operating leverage, in this part of the paper, for paper 3 and for the exam, I'm looking for two things. One is a subjective analysis of the company. What kind of cost structure do you think they have? And a second one is related to how volatile are their gross and net margins. I'll show it to you next class because we're getting a little bit behind time, so I'll make this the first thing on the next class. But what I do is I give you a spreadsheet that shows you how volatile their gross margins are and how volatile their net margins are. And my argument is the more volatile your margins are, the more operating leverage you must have. Now that's my theory. I haven't seen that written up in a textbook anywhere. And so, we'll just have, you have to just trust me on that. It's my theory. That means when you use this, if you use this especially outside of this class, you'll have to explain yourself a little bit more. But that's my measure for that second thing. So you have revenue sensitivity, and then you have how volatile are their margins, and then what is their cost structure. That's a subjective thing you just talked about. The third thing is a much, much easier one, and that's financial leverage. I'll give you a spreadsheet that shows you what their debt to equity is versus the average firms. If their debt is higher than average, then their beta will be higher. If their debt is lower than average, then their beta will be lower. Now, it all comes off of number one, revenue sensitivity. So if I start off with Walmart as a low beta company, then if their operating leverage is high and their debt is high, that's not going to push them from 0.6 to 1.5. That high debt, high operating leverage will push them maybe from 0.6 up to 0.8. So if you think it's a below 1 beta firm, operating leverage and financial leverage will just push them up closer to 1. If they're an above 1 firm, like a Tesla, but you discover that somehow their cost structure is different from everybody else's, and they have lower fixed costs and have less debt, that's not going to push their beta from 1.5 down to 0.6. It might push it from 1.5 down to 1.3. A good example is Kroger's. Kroger's is a grocery store, definitely a staple, definitely a very low beta. Usually grocery stores are 0.4, 0.5 beta, but Kroger's has a lot of debt. So because they have a lot of debt, I'm going to push their beta up, maybe the 0.7, maybe 0.8, but I'm not going to push it up above 1. So the operating leverage and financial leverage, they push you up, but doesn't make a defensive company a cyclical stock company, doesn't make a cyclical company a defensive company. It just moves them further away from the norm for their industry. So if they're normally 0.5 and have a lot of debt, you might push them up to 0.7, 0.8. If they're normally 1.7 but they don't have much debt, you might push them down to 1.5. So number one, the revenue sensitivity is by far the most important. And then the last thing you do is you look at the history. Exactly what, now here I say rolling 3-year, but now I'm using rolling 5-year. So I need to update my notes to say that, but rolling 5-year using monthly data, so I changed that. I use whatever Yahoo Finance is using. And there was a time actually where Yahoo Finance just had an error in their file. Whatever they were pulling in was not betas. Someone had linked to the wrong thing, and for a few months there, their beta numbers they were reporting were just completely bogus numbers. It looks like they're correct now because we're getting really close to those numbers. Alright, so beta is not a number you get from Yahoo Finance. I even have a t-shirt that students bought for me that even say that beta is not, they put it as a apostrophe, beta isn't a number you get from Yahoo Finance. So this is like a famous saying by Professor Sweet, bizarre saying. I even joked when I went to New York City, I went to Columbia University, and I even joked that, I was out in front of the finance department telling freshmen that they should get their beta from Yahoo Finance so I could maybe mess up the competition. But I do, as facetious as that sounds, I do think many undergraduate schools their students get their beta by simply going to Yahoo Finance and pulling the beta off of Yahoo Finance. What's wrong with that? Well, if the beta you get off of Yahoo Finance, like let's take Walmart. There was a point in time where Walmart's beta on Yahoo Finance was a negative number, like negative 0.15. That might have been right because, for 2008 they did great when the stock market fell 30-something%. But going forward, I just have a tough time believing that Walmart has a beta that's negative, that they will actually soar during weak markets. Now, they've proven it twice, with COVID-19 and with 2008, so maybe I'm wrong, but it does create a rather bizarre analysis. If your beta is less than 1, that you would expect this stock to have a required return less than the risk-free rate, that you'd be happy with Walmart giving you a return less than what the 10-year Treasury is paying you. That does not make theoretical sense to me, and so I don't like using negative betas on stocks. Students ask about negative betas. Typically, we think of gold stocks, companies that sell gold or produce gold, as being negative beta because gold tends to do well in a crisis. But gold stocks were actually down in 2008, so even in that one, Walmart was somewhat the exception in 2008. So I would encourage you for paper 3, don't go below 0.4 on your beta, don't go above 3 on your beta without talking to me, because you probably have a problem somewhere in your data. And definitely don't get your beta from Yahoo Finance. You have to do the chart I just created for Walmart and Tesla. You have to create that, and you have to put that into your paper. So what are we going to use with it? The capital asset pricing model. You should have this formula memorized. You should have seen this a few times now in prior classes. The discount rate for stocks will be the risk-free rate plus beta times the market risk premium. We've just talked about beta, so all we have left to do is the risk-free rate and the market risk premium. We'll talk about those later. In fact, I think I told you on the operating leverage, I'll show you a file for that, and for financial leverage. I think I'll wait and come back to that when we get to paper 3. So we'll value bonds first, and then we'll come back and I'll show you those so that we put it all together. Right now, we were talking about risk and measuring risk. I just wanted to do a pretty good summary of beta, and we'll get into more detail when you have to do something very specifically for paper 3. So KE is the discount rate for stocks, where we use beta. We also use it in the firm's cost of capital. It's also known as the required return. Some people say it's even the expected return. So this KE, cost of equity capital, is an extremely important number. In fact, this part of the formula, the market risk premium, I've seen several articles that say the market risk premium is the most important number in finance. So we're dealing some extremely important theoretical numbers here that are extremely important because they're used a lot in finance and they drive a lot of decisions. So what does this mean? What does this formula mean? It implies that high beta stocks should have high expected and required returns. It also implies that high beta stocks should have had high returns in the past, because the stock investors should have priced these stocks with a higher beta, so it should give you a lower price so you get a higher expected return. So you would expect on average, since their stock prices are lower because of the higher beta, that you should have gotten a higher realized return. Unfortunately, empirical studies show that's not the case. That's why I say if you go on Google and Google is beta dead, that's one of the things you'll see is that when you look at stocks with high betas historically, they've actually had lower returns than stocks with low betas. So there are some definite challenges to the capital asset pricing model. However, the studies that show that high beta stocks have lower return than low beta stocks, those are studies using regression betas, which I just told you don't use regression betas. So I prefer to use a forecast beta, and you can't really use a forecast beta historically because you're not exactly sure what beta you would have forecast 5-10 years ago. You can get the regression beta 4, 5, 10 years ago. That's easy to do. But what you would have forecast back then, who knows what that would have been. So do high beta stocks have higher return than low beta stocks? Most of the research I've seen have said no, that is not the case. So that's definitely a challenge to the capital asset pricing model. All right, so where do we go from here? We will, from here, well, let me real quickly, we've seen this. Walmart's beta 0.47. Apple's 1.25, not that far off from the long-term beta we saw the last class. Tesla 2.06. These actually make some sense to me. These don't seem too radically off. However, I have seen some that are radically off. I remember one student came to me with a paper. She wanted help for a paper in another class. They were valuing a company. Her team had a beta of negative 0.8. Negative 0.8 for a retail company. And she started talking to me and I was like, wait, don't go any further. Why in the world are you using a negative 0.8 beta for a retail stock? And she said, because that was what was in Yahoo Finance. And I said, that makes no sense at all. You need to just ignore that. You need to come up with your own beta. And that's what their team did. They changed their beta and actually ended up getting a really high score because the professor that was doing that class was really impressed that they ignored Yahoo Finance beta and came up with their own. So I'm giving you 3 examples here. I would probably use 0.6 or 0.7 for Walmart, but that makes sense. I would probably use about a 1.2, 1.3 for Apple. I might use 1.5 or so for Tesla, but these are not radically off. These look pretty reasonable. So where do we go from here? We're going to start valuing securities. We'll start with bonds and then move with stocks. So we'll be coming back to this beta and go in a little bit more detail. But from here, we're just going to start with asset valuation.